There are more opportunities for occupiers in the commercial property market than we've seen in recent times. Historically, business and property cycles have never really run in parallel, with property lagging the economy into a downturn and following behind in an upswing. And this doesn't often reflect an occupier's demand for space. However, the weight of capital seeking a home in commercial real estate today is creating its own dynamic beyond the standard supply and demand cycle. This abundance of capital is fueling new development. All they need is a tenant pre-commitment to get it to work. So occupiers can secure purpose-built premises at a market competitive rate if they commit to a new development. And of course, this is an opportunity to create space and a workplace experience that will resonate with your people and your brand at the same time. All commercial property markets across the country are weighted in the tenant's favour, and we expect that this will continue across all markets with the exception of Sydney and Adelaide, where we expect a rebalance around about 2017. In Sydney, incentive levels are sitting in the low 30% rental range. However, vacancy has tightened in the A-grade sector of the market, reducing the choices available for small to medium tenants. In the premium market, traditional users of space are in contraction mode and looking to do more with less. Barangaroo is the largest development precinct in the country, and that'll deliver 267,000 square metres of office space when completed, with 66% of that already pre-committed. There's potential for another 272,000 square metres to come online in Sydney in other developments if they achieve significant pre-commitments. This potential new supply, as well as the backfill created with tenants relocating to new developments such as Barangaroo, will create opportunity for other occupiers to upgrade in that market. The strong investment demand for office stock in Melbourne has driven down investment yields, which has had a flow-on benefit to tenants. The lower yields have seen a reduction in the economic rent required to make a development feasible, resulting in lower rents or increased incentives. Melbourne has seen development concentrated in the Docklands precinct, with minimal new supply in the CBD. In fact, 79 of the sites sold in the Melbourne CBD over the last 5 years, only one of these is actually slated for office development. We expect to see only minimal rental growth in the near term in the Melbourne market, with the exception of some precincts in the CBD. Incentive levels are expected to remain around the 30% mark for the foreseeable future. Corporates in Brisbane are faced with a plethora of choice in existing and new stock. Despite the high vacancy of 14.5% in the CBD and 16.7% in the near CBD markets, developers are willing to build new product with a solid pre-commitment, given the strong investment demand for commercial assets. Incentives currently range from 35 to 42% for existing stock and 25 to 35% in the new development. In addition to the usual incentive of fit-out contribution and rent-free or abatement, the market is seeing examples of developers taking over lease tails of tenants that are pre-committing to their buildings, as well as delaying lease commencement dates. Perth is witnessing the almost perfect storm for tenants, with the weight of capital seeking quality office product. The government is investing in development to drive growth, and one of the highest levels of vacancy the Perth market has seen at 19.6%, including a lot of sublease space available. However, with the weight of investment capital interested in Perth's office market, there's a real advantage for tenants with a footprint of more than 4,000 square metres to take advantage of this investment cycle. Over the next 12 to 24 months, tenants will be able to secure new office premises with greater amenity, more efficient floor plates, increased transportation links in arguably better locations than they already have.